Hi, and welcome back to another episode of the Mortgage Musketeer, where today I am focused on my realtor friends, and we're going to be talking about what loan officers really wish that realtors knew. This is not one of those snarky videos. This is an actual educational video for my realtors so that they understand how they can best help the entire transaction, because it really is all for one and one for all. If you like what you hear, please subscribe and share it with all your realtor friends that you know, because I think you're going to find it useful. All right, intro. All right, I'm coming at you with eight tips that loan officers wish that realtors knew. And let's start off with number one, inducements to purchase. All right, how many of you have been working on this contract? You did an amazing negotiation and you got everything that the buyer wanted and the sellers are okay with it. And then you turn it into your loan officer and your loan officer calls you and says, hey, you need to take certain things out of the contract. What? Yes. Happens. And this is why. Because it is an inducement to purchase. But people may say that, but what the heck does that mean, and why doesn't anybody ever say, don't do these specific things? So we're going to right now. Okay, so easiest if I just post the list so that you can actually see it. And this is what the regulations say. Certain expenses or benefits paid or contributed by an interested third party on behalf of the borrower are considered inducements to purchase and result in a dollar for dollar reduction in the sales price of the property before applying the appropriate loan to value ratios. These expenses include but are not limited to contributions exceeding 6% of sales price. You can't exceed 6%. Contributions exceeding the actual cost of prepaid expenses. Decorating allowances. Stop putting in decorating allowances. Repair allowances. We see this all the time. First of all, if there are repairs that need to be done, the last person in the universe that you want to see that repairs need completed is the underwriter. Keep repair allowances out of the contract. Moving costs. All right, the seller cannot pay for the moving costs. Payoff of consumer debts. They also can't pay off the debt so that the borrower can qualify. Personal property. This is hands down what we see the most for an inducement to purchase. All right, so understand that personal property is that pull furniture, that she shed that the buyer absolutely wanted to make sure that the seller didn't take off the property. You know, anything that is not physically attached to the property is personal property. And that means that the underwriters will deduct the estimated value of that item from the sales price. You don't want that to happen, so stop putting those items in the contract. You do not want the underwriter to see that. Now, there are a few exceptions. Personal property replacement of existing personal property items listed below are not considered an inducement to purchase, provided the replacement is made prior to settlement and no cash allowance is given to the borrower. That's why these items can be left in the contract when you write in there, hey, these items are going to stay with the house. That's why these items aren't considered an inducement to purchase. Range, refrigerator, dishwasher, dryer, carpeting, window treatments. Other than that, it should not be in the contract. So please stop putting personal property in the contract, because your loan officer is going to have to call and have you do an addendum or an amendment to get it removed. Every now and then you can get away with, hey, I'm leaving this item with, you got to get a letter of explanation from the seller saying, or it has to go in the contract saying this item is being left behind with no value. In other words, it's not part of the negotiation. Okay, and that's a case-by-case basis. You got to talk to your loan officer, but do that before you write the contract. Don't put it in the contract until you've spoken to your loan officer. Okay, number two, the earnest money deposit. Please understand that the earnest money deposit is part of the assets. In other words, it's going to be applied towards the down payment, which means it has to be sourced. And what that means is that when a buyer hands you money for that earnest money deposit, it's got to be from a sourceable place. In other words, it cannot be cash. Cash is the devil. The very first video I ever did was based upon cash is the devil, and that's because it cannot be sourced. So if a buyer walks up to you and hands you $500 in cash, saying, here's my earnest money deposit, you need to hand it right back and say, you need to get it from your actual bank. All right, so the earnest money deposit is critical. Most of the time, we end up backing it out of the assets. And what that means is that we really don't count it. So if they had, for instance, $5,000 in the bank, they're really only getting credit for about $4,500 because we have to back it out because it's hard to source. Or it takes a while from the time that they hand it to a realtor to the time that it's turned in to when it's actually debited from the account. Part of every condition sheet we ever get once it comes out of underwriting, it always says, show us where it is deducted from their account. So we have to actually get their bank statement and show that if it was a $500 earnest money deposit, we have to show a debit of $500. And this goes back to why I talk to the buyers all the time about having very exact amounts, because we have to show a copy of the check and we have to show that check being deducted, because what they're doing is they're ensuring there's enough assets left in the account after the earnest money is deducted. So really important in that stage is just not securing funds. You need to think about the transaction as it's going forward, because you typically don't see it, that money has to come from a sourceable place. On that note, if all they have is a cashier's check, make a copy of the cashier's check. Make a copy of every check and send that directly to your loan officer, because we have to have a copy of it. So if they ever just hand you a cashier's check, incredibly important that you make a copy of it. And then we have to talk to the buyers and make sure that they only get a cashier's check for the exact amount, because it's really a cash deduction. So it'll show, for instance, minus $500, or sometimes there is a little bit of a fee, so $500 and maybe $2 or whatever that the bank might charge. If they do, that's okay, we can source that. But it needs to be just for that amount, so they don't need to get groceries, pull out $700 worth of cash at the ATM, then walk in and get a cashier's check. That's a no-go. Has to be a very singular, individual transaction for the earnest money deposit. The best way is for them to write a check. Now when they do that, make sure we get a copy of it and make sure you deposit it right away, because that is about time. I can't tell you how many times I have submitted a loan, got it through underwriting, it come back out, one of the conditions is I have to source the earnest money deposit, and it hasn't even been cashed. So we have to wait around until it's debited from the account. So time is of the essence. And I know a lot of brokerages say, well, it has to be turned in by certain, 72 hours or whatever the case may be. Okay, that's fine. But you'd be amazed at how many times I find that that is not the case. So please, make a copy of the check, deposit the check as soon as humanly possible so we can show it deducted from their account. That will speed up the underwriting process. And do not let them hand you cash. Even if you give them a receipt, that does not source it. Cash is the devil. Can't be used. Okay, number 3. Government loans have an inspection component to the appraisal. All right, so that's every one of them. That's your FHA, your VA, and your USDA. They have an inspection component to the appraisal, not to be confused with the homeowner's inspection. The appraiser has a checklist for a government loan that they're going to go through and just check off. They're a little bit different for each product, but the core things that we run into are really the same. All right, so if you don't know what an appraiser is looking for with an FHA appraisal or any government appraisal, I'm going to put a link below that goes to my website. It has a list that you can actually download for common things that are seen or that we get a subject to completion in the appraisal. Subject to completion is a bad thing. If you are listing a property and you're saying, hey, this can go FHA, USDA, or VA, you need to make sure that you have actually looked around and seen, okay, we're going to need a handrail here, based on these steps. We're going to need to make sure no peeling paint. We have to have access to the attic and the crawl space. And there's a list of things that you can quickly address with the seller if they're going to accept an FHA purchase, because they have to make those repairs. But you want it to be done before the appraiser gets out there. Otherwise, it's going to cost $150 to $175 for the appraiser to go back out there once they identify things subject to completion. And you don't want to do that because the buyer has to pay for that. And as a buyer's agent, you don't want your buyer to have to go out there, and there's nothing that we can do about it. As a loan officer, we get the appraisal in. That's when we see if it's subject to completion or as is. We want to see it as is. So address the items. If you know at the contract, the buyer's agent should be telling you if it is a FHA, VA, USDA, or conventional loan. That should be in the pre-approval letter, right? So if it's not, that's an issue. Every now and then it has to flip. Okay, every now and then there are exceptions to that where it may start out conventional and end up FHA or vice versa. That should be an exception though, not a rule. Number 4, condos are a pain in the butt. Yeah, I said it. Condos are a pain in the butt. Do we do them? Absolutely. Am I good at them? Absolutely. Do I like them? No, but I'll do them. And when I'm dealing with a buyer, because there are legitimate reasons for people to buy a condo, I'm happy to do it and I'm happy to help them. The idea is to take care of the client. However, what I want realtors to understand is that one of the reasons why we don't like them is because we deal with third-party entities, the condo association. And the condo associations run the gamut. They're either pretty good, in which case your condo is probably going to turn over pretty quick, or they are a nightmare, in which case it could drag out. And it's a third party and there's nothing that we can do. So they're all different and there's no way to anticipate it until you actually get the contract. The issue is, being a third party, is we have to request condo docs. It also depends if it's a limited review or a full review for the condo. Don't know until we actually get into the process. And here's the thing. They can charge a buttload of money for the condo docs. Sometimes on the large condo associations, they don't want to talk to people. They say, hey, go to a website or call this number or however to order the docs. And then we're just waiting. Okay. Same thing if it's an actual entity that you can talk to. Sometimes they don't answer the phone. Sometimes they won't respond. Sometimes, you just never know what you're going to be dealing with. If they're a condo association that actually responds to you, you're like, hallelujah, praise, praise, because it's just such an X factor. All right, so the other piece to that, though, is that there's homeowners association fees that go along with it. And I've seen $500, I've seen $750 a month condo association fees, that had to be one heck of a condo, and some of those are amazing. Some condos are great, but in general, just understand that if things are dragging out, oftentimes it's because of the condo association, not because of anything else that's going on, because the rest of the loan is normal. No difference in the loan. It's really all about that condo association. Okay? All right. Number 5. Buyers take forever to get you what you actually request and to get homeowners insurance. All right. So the way that I set it up oftentimes is the hot potato, right? So I say, hey, the underwriters are going to ask me, for certain conditions. I'm going to tell you this is what they want. That way I don't want it, giving it to you. And then you as a buyer should be getting whatever the docs are requested and give it back to me because you don't want it. And then I don't want it. I want to get it back to underwriting. That's the idea. Where we run into an issue is I will ask for apples and the buyer will inevitably give me oranges. And I'll have to say, okay, thanks for the oranges. I appreciate it. At least, we're in the fruit category, but that doesn't work. I need apples. And then they'll give me a banana. And you're like, okay, all right. So I appreciate, you're really kind of looking for this, but I really need the apple. Most common aspect of this is assets. Assets, your bank statements are the hardest part to deal with. And that's another reason why I have all the videos about assets. It's because no bank is the same, and some are very user-friendly and some are not. And a lot of people aren't used to dealing with getting transaction histories and full bank statements, and it really just depends on the size of the bank and where they're at and their technology. So you just never know. But those things take time. Okay, so it's going back and forth. And then as far as homeowners insurance is concerned, they're supposed to go shop for the homeowners insurance, but for whatever reason, they always tend to drag out. So what I've done is I've actually got really good relationships with different good insurance agents in different locations of the state and the country, depending on where I'm actually doing my business. So really important pieces, again, all for one and one for all, which is why insurance agents are also incredibly important, because some are really easy to deal with and some are a nightmare. All right, so who you deal with is important in the transaction. Part of that all for one and one for all. Okay, number 6. Where's the appraisal? I don't know. I was going to ask you. Okay, so Remember that there's the appraisal management company. We have our bench of appraisers and whatnot, but the appraisal management company is the buffer between us and the appraiser. We're actually not allowed to talk directly to the appraiser. What I'm always confused about is when we order the appraisal through the appraisal management company, we always use the realtor as the point of contact. So your best bet to find out what is going on with the appraisal, if it isn't turned in yet, is to talk to the other realtor. Whoever was the point of contact, typically the selling agent, they're the ones that are going to be having the knowledge of who that is. If a selling agent doesn't answer the phone for the appraiser, some appraisers are very knowledgeable or resourceful. They'll go out and find the phone number for the seller and they'll set it up with the seller. So as a selling agent, make sure you talk to the seller, to your seller, and say, hey, if the appraiser reaches out to you, be sure to get their name and contact number. That way, you have a way of reaching out to the appraiser when they turn into a ghost. Because it happens all the time. As an appraisal management company, they'll send us the expected due date. The appraisal may or may not, the appraiser may or may not turn it in on that expected due date. Or if they do turn it in, the appraisal management company might find issues. Most of the time there's some type of administrative errors. They'll kick it back to the appraiser. And then when is the appraiser going to turn it back in? Excellent question. I can't talk to them. All I can do is beat up the appraisal management company. I sit on the sidelines along with the buyer and we twiddle our thumbs until it comes in. Until it comes in, I don't even know who the appraiser is, but somebody does. One of the agents should, or at least the seller does. So there is a way to cut through all that if up front you realize as realtors, you can reach out to the appraiser where I cannot. Okay? So keep that in mind when appraisal's ordered and see if you can't make sure to control that point of contact whenever the appraiser reaches out. All right. Number 7. Don't pre-qual your buyers. All right? So experienced agents will have a good sense of what's going on and who's worth their time and who should send some alarm bells. But it's no substitute for an actual pre-qualification. I've had many instances where I receive a contract and nobody actually did a pre-qual because the buyer said, oh yeah, I make X amount of money or whatever the case, and when I actually do the pre-qualification, they don't qualify because not all income is the same, not all assets are the same, and you never know what the debt is. I have people forget all the time. I had a heart surgeon forgot that he owned 20 square blocks of land in Florida. You just never know. So you got to go through the full pre-qual. Plus, there's people who go through divorces that have a lot of alimony or child support. Like you just truly don't know. So as a loan officer, I'm trained. I get the questions to pull everything out to make sure that we have an actual qualified buyer. I understand every realtor has kind of a different technique, and some will go out and they'll show them some homes, and then they'll get them pre-qualified. Got it, no issues. But do you just be careful that you can't really know everything that's going on. And even for us, we have to run it through the automatic underwriting system because I can look at somebody and think, yeah, they should be qualified. I just had one. I had one with a 701 credit score that I couldn't get approved. Blows my mind. Makes no sense. But it's the automatic underwriting system. And that automatic underwriting system is the same thing that the underwriters use. So as a loan officer, that's what we do. So just be careful about that. All right, and number 8. Seller concessions. All right, understand that conventional loans cap out at 3%. The maximum seller can give is 3%. Where that makes a difference is when you have somebody who is a conventional buyer, but they're buying a less expensive house. For instance, a $100,000 home, the maximum seller contributions is $3,000, which probably is not going to cover all of the closing costs and prepaids if they need that. If you have a $200,000 home, 3% of that is $6,000, which probably will. So you can see that it depends on how much the home is being sold for as to how much it's going to cover. An FHA loan or a government loan, all the government loans are 6%. So you might run into an instance where you have a conventional buyer who can only afford to buy with an FHA because they need maximum seller contributions. So know how that works when you're doing the contract, because when you're into a lower amount on a conventional loan, it is better for you to put in 3% than it is to put an exact number. because if negotiations move back and forth, it's better to use that percentage to your advantage than it is to be locked in at a very specific number. FHA, it can fluctuate a little bit, but conventional, real important that you talk to your loan officer and find out what is the best strategy before you write that contract, because it's always easier to get that before you write the contract than after, as you know. But this is what I want to really bring up, and I've talked about this in another video that I'll put a link in, and that's about how you explain the seller concessions to the buyer. And it depends on where you are in the country and what is traditional. Okay, so I know in Eastern Kentucky, what they do is they negotiate the sales price and then they tack on the seller concessions. So the sales price actually rises, and that can be confusing to the buyers. Whereas a lot of other places, they don't necessarily do it like that. They put those seller concessions as part of the negotiation so that the sales price is the sales price. Two differences. Check out the video to explain a little bit more detail. All right, so hopefully this was helpful to you. It lays out some things that I really wish that you guys know. Be sure to subscribe and please forward it to all the agents that you know. This is very useful, and it would be especially useful for some of the newer agents and some of the older agents as well. All right, it was a pleasure having the opportunity to share these things, and it really is what loan officers wish that realtors knew. Not all inclusive, but it's a pretty good list. All right, it's all for one and one for all.